All right, we are live. So, welcome to Work It Wednesday, and thank you so much, Josh Schoenly, for actually coming on and talking to us about loan types. So, the reason I invited Josh is because when it comes to value propositions, I really like the experience he's had, not only on the real estate front, but he works with mortgages as well with NEXA, and they've been wonderful. But I started thinking as a real estate agent, there's so many ways that we can showcase our value proposition. And one of the things that I think a lot of agents, especially newer agents, may not realize is that understanding the different loan options can not only help make you more valuable on buyer side, but also on the seller side. For instance, one of the things that I had a discussion with one of my newer agents, this was back, way back when, but they went under contract. And when we were discussing the terms, it was confirmed that they had gone with an FHA loan, traditional, not the FHA rehab. And the home really needed a lot of work. It not only needed a lot of work, but there was a lot of things that someone who's done this business for a long time know would be major red flags. And you can't just assume that the listing agent is going to, number one, know that, or number two, share that. So essentially, they set their client up for failure from the start by accident because they didn't realize the trouble later on down the road. So that's why I wanted Josh to come on here. We're going to talk about some loan options that will be really helpful for you to know to better assist your buyers and sellers. And then we're going to talk about the value proposition and when would be a good time to showcase those loans to our buyers and sellers. So Josh, let me go ahead and make you co-host as well. And I'd
Great.
love you to go ahead and introduce yourself and share a little bit about what you have for us today.
Yeah, absolutely. Well, thank you for that. So, as Jennifer mentioned, I'm dual licensed. So I'm on the real estate side. I'm with EXP. I've got a local team, and I've got an organization in I don't know, a bunch of different states. And about 2 years ago at this time, I also got licensed on the mortgage side for a whole bunch of reasons. One of the biggest being for my organization and for a lot of agents that I help and coach, et cetera, not having a good mortgage partner to be able to facilitate more deals and to help more clients. Because unfortunately, a lot of lenders, loan officers, mortgage pros, if the borrower doesn't fit into some little box, many times we cast them away and maybe give them a plan for how to get them to fit inside the box, when the reality is there may be other programs that we can immediately be pivoting to be able to help them realize their dream of home ownership or realize their dream of getting started with investing in real estate. Right, it could be any number of things. So when Jennifer reached out to me, I figured I'm going to put together a little buffet, I'll call it, of some different loan programs and options for you to be aware of, maybe, or to be reminded of. Some of these you might have been, heard about before, or be somewhat aware of, but maybe just forgot about. And I think the big value proposition here is that awareness means that when you have conversations or when you hear people talking about X or Y or Z, and they have a misconception, for example, that they have to have, I don't know, a 680 credit score, you can be educated enough to say, well, actually, FHA, if you have a 580 plus, you can still qualify for 3.5. And if you have a 500 plus, you still may qualify. You just might need 10% down. So just to have those educated conversations where you can immediately demonstrate that you're a market expert. And when you do those kinds of things, people are attracted to you, right? They become more curious, and they realize, well, this is someone that obviously, has knowledge and might be able to help me. And in those scenarios, a lot of times don't have to compete. So I'm just calling this 5 unique home loan options you should know about if you want to sell more homes in 2024. I actually have 6. The sixth one isn't maybe directly related to helping a borrower buy a new home, but indirectly might be of help to you as well. And I'll get to that at the end. I'm just going to bounce around. I'm going to share some of these. And on the slides, there is, in many cases, ways that you can do a deeper dive. So, for example, there are QR codes some of which are to a deeper dive session that we did specifically around a particular program for those of you who are curious or want more information. And, you can also get back to Jennifer or myself. I'll put my contact information at the end as well. If you have questions, or if you have a client that, the scenario, one or more of the scenarios might be relevant for. So the first one Jennifer asked me to talk about was a 2-1 buy down, a 2-1 buy down. But I've actually included 3 options here. There's a 1-0, there's a 2-1, and you can even do a 3-2-1. Okay. Now, rates have come down a bit over the last 6 or 8 weeks. So this may or may not be as relevant in overcoming an objection as it was 8, 12, 16 weeks ago, let's say, but still important and relevant for you to know because, well, for a whole bunch of reasons, but one of them may be you may be talking with a potential client or borrower and they bring it up, right? So you want to have context and be able to have an educated conversation with them if they do. So very simply put, this is a temporary reduction in the interest rate for the borrower. Okay, so a 1-0 means that for 1 year, they would have a 1% lower rate. So just for round numbers, if the rate today was 7, a 1-0 buy down means for the first 12 months, their rate would be 6%. And then after those 12 months, it would go to 7. A 2-1 buy down means, again, that 7% rate, and I'm just using it because it's a round number. I'm not quoting rates here, okay? It's just a round, easy number. It means year 1, first 12 months, 5%. Year 2, okay, so months 13 through 24, 6%. And then months 25 and on would be 7. And you can cast that out, a 3-2-1. 4 would be the rate for the first year. 5 would be the rate for the second year. 6 would be the rate for the third year. And then it would go to 7. Now, these can be a great option in certain situations and scenarios. Okay. But it's not the right fit for everyone. And so that would be a conversation. Things that you would want to know: how long are they planning to keep the home? Okay, for example, because there's a cost benefit to it, right? And we have to figure out, does it make sense to take the seller help that we're going to need to get this buy down, to buy down the rate, or should we just use that to minimize our out-of-pocket costs because we're probably only going to be in this home for 30 months anyway, whatever it is, right? So it could be a good fit, but it's important to understand what are their short-term and long-term goals as it relates to this property and the financing on it. And one thing, this is a very simple concept, but I think is a very powerful one. You can always, theoretically anyway, renegotiate your interest rate on your mortgage. You cannot, however, renegotiate the purchase price you paid for the property. Again, very obvious, but you can't 18 months down the line go back to the seller and say, I'd really like you to give me back 10,000 of the money I paid you for your property. But you can, in 12 months, 18 months, 24 months, 30 months, you can renegotiate that rate in the terms of a refinance, right? So I guess the point I'm highlighting there is, if the seller's agreeing to 10,000 in help, or 15,000 in help, or 5,000 in help, depending on the situation, you might just take that in a price reduction on the property too, right? So there's any number of ways that you can use those funds. You can see some basic numbers here. In this scenario, the cost for the 2-1 buy down in this on the screen here, with a purchase price of $650, a loan amount of $550, you're talking about just under $13,000 in cost, which would be the concessions that you'd have to negotiate on some level, or work into the loan on some level. Okay, so important to be aware of those, have some basic knowledge of those. If you have a scenario, it's also can be a powerful tool as a listing agent. So you've got a property that is, just hasn't been getting activity. It hasn't sold. You could negotiate with your seller. Hey, Mr. or Mrs. Seller, instead of dropping the price, what if we offer $10,000 in help for someone to a potential borrower to get a 2-1 buy down? Okay. One last thing on this, because I got a number of things that I want to go through and I want to keep this punchy. One last thing on this. The borrower has to qualify for the full amount. Okay. So understand that they still have to qualify for whatever the full rate is, whether it's 7 or 7.25 in this example, or 7.5 or 6.5. It just means that they get to keep more cash in their pocket depending on the length of those reductions. And I said one last thing, but I lied. The other option too is if they're going to be in the home for a long time, they could do a permanent buy down. So they could take that money and permanently buy down the rate, so they're getting lower interest over a longer span, right? So lots of options there as far as that goes. And then there are some examples here, which, by the way, Jennifer, if she hasn't already shared, you can have these slides, joshvips.com/workit, joshvips.com/workit. So if you
I'm
miss
going to go
anything,
ahead and put it in right now.
yeah. So
So you
if you
guys
miss
will
any of
check the
these,
chat. Yeah.
yep, it's just Google Slides. You can check it out after the fact. So program number 2 that I wanted to highlight is something called DSCR loans. DSCR loans. Okay, and DSCR stands for Debt Service Coverage Ratio, which is just a fancy term that I'll explain in more simple terms here in a minute. For those of you interested, I'm just going to give you a little highlight here, but for those of you interested, the QR code on this screen will take you to about a 50-minute sort of deeper dive session that we did on DSCR loans. So these are specific for real estate investors. They can be used to purchase an investment property. They can be used to refinance an investment property. The major selling point or idea around DSCR is that instead of using the borrower's employment or income to qualify, the property qualifies based upon the income it will produce. And most DSCR lenders are looking for at least a 1-to-1 coverage. In other words, at least that the income will cover the debt service on the property in a 1-to-1 fashion. Now, that may or may not make sense from an investment standpoint for the client, but just to give you some context. Now, we do have lenders that will go down to a ratio of 0.65. And also, when the ratio is better, we can often get better terms, either a lower rate, lower fees, etc. Okay, so to qualify for DSCR loans, we're not looking at the income for the borrower, but we're checking the coverage ratio, the debt service coverage ratio. They will need to have a FICO score, generally speaking, of 620 or better. The options are, I'll just say very transparently, the rates and fees, et cetera, are significantly better at 660 or 680 plus. Okay, but we do have options. I think we even have 1 or 2 lenders that will go down to 600 on that. And then the other consideration is the LTV on the property. Okay, so we have lenders that will do 75, 80, and for experienced investors, we even have some where they'll do 85 or 90% LTV. Now, you have to be experienced investor. In other words, you have to have had rental investment properties, generally speaking, for at least 2 years and have multiple. Okay. And one of the things I didn't mention it at the beginning, but one of the reasons that I decided to work with NEXA Mortgage on the mortgage side, the loan officer side, is we have access to over 230 wholesale lenders and then over 4,000 private and hard money lenders. And the only reason I share that is, generally speaking, if we can't find a product or program for the client or potential borrower, I would say that you'd be hard pressed to find someone who can. We have the ability to go and shop all of these different options to see how we can make make the puzzle pieces fit together for your client. So this is a great program. Generally speaking, very simple, can be quick and easy. I think Jennifer, I don't even know if you were on. We were on a mastermind a couple of weeks ago, and there was a woman on there singing the praises of a DSCR loan. They used a DSCR loan to purchase a property that one or two of her children were actually going to be renting out to them. So yeah, I mean, that potentially is a great strategy on a number of different levels and options. And generally speaking, when we have someone interested in a DSCR loan, we have a little one-page PDF where we get some basic information about the property, and then we go and shop for the best deal on the DSCR loan for the client. And if you'd like a copy of that, my email will be at the end here.
Josh,
Now, this is one. Yeah, go ahead, Jennifer.
If we could just go back to that DSCR. So
absolutely.
I made a video on it a few weeks ago, but you know what's really cool about it too? Basically for investors or even like realtors like myself, right? Like you get commissions, so we kind of rely, our income is different. But what's so cool about it is, let's just say some investor has money coming in that is from different sources at different times. What's really cool is because they don't use employment history, they're only using, now, correct me if I'm wrong, but I heard the appraisal process is different. They don't necessarily appraise it for the total value of the property. The appraisal looks at the rent income that could be brought in. So for folks like us or investors who have money just coming in different flows, as long as they have a little bit of money, right, for the loan type, and they have a property that they can find that can bring in rents either even or above, right? Then this loan type could work for them as well. And it really takes the stress out of looking at your employment history, especially when you're in an investment kind of lifestyle, right?
Yep, 100%. And I'm glad you brought that up. So the type of appraisal, it's a rental appraisal. So it's appraising the property based upon the rental income, not necessarily the traditional residential comparable sale type of appraisal that we're used to. If you got an FHA borrower who's buying a primary residence, that's a great point.
It's a great product.
Of distinction there. Yeah, absolutely. Absolutely. Okay. So here's another one. This is a great option to overcome an objection that I think many of us, myself included, have been, coming up against, which is, sure, I'd love to sell my home. I would like to downsize or right size, or I'd like to trade up, but I don't know how to do both of those things at the same time. Or I'm scared that, if we sell our home, I don't want to end up homeless. Any number of, related objections that you may be hearing or have heard over the last 6, 12, 18 months. So this buy before you sell program, which the QR code deep dive session on it, it allows us to determine. So step one in the process is we look at the departing residents, the property that they would be selling. And it's a very simple, easy process where we are able to identify how much equity can we unlock for the purchase of the new home. And then we get essentially what becomes a backup offer on that home, which allows the client to make a non-contingent offer on the new home, right? Because, I think we've all experienced when we're in a competing offer situation, if ours is contingent, we're making it very difficult on ourselves to get it accepted. So they can make that non-contingent offer on the new home. They can settle on, close on, move into the new home. Even potentially, we can do some light repair and work to the departing home to present it in the best light possible. And then let's say if Jennifer was working with the client, Jennifer works to sell the departing home. And if we can't sell it within 90 days, then they can take the backup offer and settle on that. Now, one thing I'll say here is, I think at this point, there's been one instance where they had to take the clients had to take the backup offer on like 2,000 of these type of transactions. In other words, in most cases, we end up selling it and selling it for more on the open market, but it allows it addresses a concern, right? They don't have to move twice. They don't have to make a non-contingent offer. They can make sure that they're getting the home that better fits their family's wants and needs without ending up being quote unquote homeless. There is a fee that is paid for this program for the unlocked equity. It's 2.4%. Okay. Now, the thing that I would mention here is the company that we partner with for this program, on average, the vacated homes, because we can present them in a better light, on average, they sell for 3 to 5% more. So in most cases, there's still going to be a net positive scenario or situation, and they're going to, get their family into a home that makes sense, right? So there is a fee for that convenience, but generally speaking, in most cases, they're going to end up in a net positive after it's all said and done either way.
What
So
is
there's
the,
more particulars to this, but go ahead, Jennifer.
sorry, what is the fee on? Is it on the value of their current property or the purchase of their next property?
It's on the backup offer on the departing residence. So if the
Okay.
departing residence was 500,000, it would be 2.4% on the 500. And yeah, the new residence, it doesn't, it could be whether downsizing or trading up in either scenario. And honestly, all of these are just a great talking point. It may be that when you have a deeper conversation with the client, because you're able to overcome an initial objection and get into a deeper conversation, this might not be the right fit for them. It might be, but there might be a better way to navigate the situation. It's just opening more doors and conversations for yourself. Okay, very quickly here, VA and other assumable mortgages. Okay, some people may know, some people may not, but VA, FHA, and USDA are actually assumable mortgages. Okay, those are mortgage types that can be assumed. That said, it might not make the most sense for the borrower or the seller. But let's explain how that works. So in that situation, the borrower, you have to have a willing seller, okay? A seller willing to offer their home for sale with the mortgage assumption. B, the borrower must qualify with the current mortgage servicer. Okay, so the borrower must qualify. It doesn't mean anybody can't come in and assume the financing in this scenario. And the last point here that is incredibly important is, in most cases, there's still going to be an equity deficit that the seller is going to expect to be made up in some form or fashion. So the borrower is still either going to need cash or potentially qualify for a closed end or an even open-ended second mortgage. So this is a cool idea and concept. And if you have a seller who's open to the idea and willing to have a conversation around that idea, can be very useful in generating more interested buyers. But ultimately, there are some hurdles to overcome with this. And I thought I had here. It's basically in the VA process, you can see here there are 9 steps involved. The last big issue with assumable mortgages is you have very little control over the timeline from the mortgage servicer. In other words, they're not super motivated to process these type of assumptions. And so if you have a seller that has a specific timeline that they need to hold, or a buyer that has a specific timeline because of a lease ending or whatever, this may not be the best option, because you just kind of, it could take 30 days, 45 days, 60 days, 75 days, 90 days. It's really up to the individual servicer, and and how motivated they are, and factors, too many factors outside of your control, let's say, but still good to know and understand and be able to have a conversation with a potential seller. Or depending on your market, I don't see this marketed often in my market. However, I had a client late spring or early summer where the seller was offering a VA assumable mortgage. It didn't make sense for them, but good on the listing agent to have that conversation with the seller and present that as an option as we were negotiating, because it was a very low fixed rate on the on the current mortgage. So, all right, a few more here, because I'm running out of time quickly. Down payment assistance. We have been having some tremendous success of getting into more conversations, getting applications flowing, and getting pre-approvals flowing around the conversation of down payment assistance. There are lots of different down payment assistance programs available. Some of them are grants, some of them are loans, some of them are forgivable loans, some of them are tax credits. There are some that are county specific, state specific. There's all mannerisms of these programs. Okay. And exploring them and understanding those makes a lot of sense. And I would recommend that you all do. But there's one that I would highlight that we have been driving a lot of attention to, is a national program that is 5%, and there's a forgivable and a repayable option the borrower can choose. And the requirements are a lot more lenient, let's say, than many of the down payment assistance programs. So let me paint a picture for you. You have a qualified borrower. They can qualify for FHA at 3.5% down. If they qualify for this down payment assistance, they can get 5%, which means not only are they covering the 3.5%, they've got 1.5% towards closing costs and settlement fees. And maybe you can negotiate with the seller for 1% seller help or 2% seller help. We have a client who I think is settling this week. Maybe it's next week. They are going to be purchasing a home in Kansas, okay, just for whatever that's worth, for like $13 out of pocket. Okay. Not a guarantee. Results not typical, but possible. So just being aware of these, I think, is important. The QR code on these two slides will take you to a session we did just last week on down payment assistance and some of the things to be aware of with them, and really highlighting this program because, unfortunately, many of the localized programs have very defined criteria. For example, if they make over X amount of income, they won't qualify, right? Well, that immediately excludes a lot of folks that you may be having conversations with. And this program is a great workaround for that. All right. I've got literally like 60 seconds. One other, that's 5. I wanted to give you 6. Another great program that we're having a ton of success with is called the 5-Day HELOC. This is a wonderful program for folks who want to tap into their equity without losing their current low interest rate. It's an automated, all online application. They can get up to $400,000 of their equity unlocked. It can be first, second, or third lien position. It can be on primary residences, but also secondary and investment properties. The max available on secondary and investment properties is lower. It's $200K, but they can still do that. And lower rates than a typical credit card, et cetera. It's great for debt consolidation, renovations, or it can be a great way or something that you can combine with a DSCR loan. So you've got somebody, they want to get started with real estate investing, they could use the 5-day HELOC or another closed-end second mortgage to unlock equity that they can use for the 20 or 25% down so they can get started building a real estate investment portfolio. I am so sorry that I have to run, but Jennifer has the link to the slides. My contact information is on the last one. The QR code's on here. I forget which is which, but I think the top right is just if you have a borrower or you need have a financing or mortgage need. It's just a simple online application. You can create a free account, start there. And the one bottom right is our dual licensing program. So for those of you that might be interested, like I was, in becoming dual licensed, so that you can add mortgage revenue streams to your business, and increase your revenue without necessarily having to sell more homes or work with more clients. That'll give you just a short overview of what that is and how it works, and the income possibility with that. Requires work, okay, but something to explore for those that might be interested.
Josh, thank you so much. And real quick before you go, are you licensed
Yep.
in Georgia? Gia would like
Yes,
to know. Okay,
absolutely.
wonderful. Yeah,
We
I'll take
sure
it
are.
from here. And
Thanks, Jennifer.
thank you. So,
Appreciate the invite.
oh, of
Happy
course.
holidays, everybody.
Anytime. Bye.
Bye-bye.
So let's go ahead and make me the host again. There we go. So thank you guys so much for joining. And that was a really fast forward version, but here's what I like. So NEXA and I have been working together for some time now, and they are very creative. My clients have loved speaking with them because here's the thing. As a realtor, our vendors are so important. They're just as important as we are. NEXA team really works all over the United States and probably other places as well. Now, because that was so fast forward, I want you to know that the link I put in the Zoom meeting and also in the Facebook Live has more detailed information on the loans we just explored. A lot of those QR codes will take you to previously recorded masterminds or videos that were dedicated to those one specific loans. So feel free to take a look at it. And also, I would definitely connect with Josh and his team because they have helped me so much with my clientele. Their messaging is great. They even give you strategies for reaching out by text, asking if they're interested in discussing with a lender about zero down payment options, etc. So you'll definitely want to check that out. If you are able, at 1 o'clock, we have that Street Text year-end virtual summit. The link is also included. That's going to be a great way. We have a lot of guest speakers that are going to go on, talk about goal setting, talk about what worked for them, what ad strategies they're using. And also, please, because this is a new group, if you don't mind sharing the link to the group that's also included with a few of your friends, your real estate agent friends, that would be so much appreciated. That way we can continue to build the group and continue to bring some value to everybody. Have a great day, and I hope to see you guys later. If you have any questions, reach out to me. Bye, guys.